Hello, hello, hello. Welcome. For those of you who are watching me for the very first time, my name is James Ambroise, and on this channel we cover how to pay off debt faster than any other debt repayment method out there. We cover basic bookkeeping and accounting for someone who just started out a small business. We cover basic personal income tax to include a Schedule C, Schedule E, depreciation. I am also the author creator of Ambroise Method 1.0 and Ambroise Method 2.0. Ambroise Method is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to debt snowball, debt avalanche, velocity banking. Real quick about my credentials, I have been or am a bookkeeper and accountant, QuickBooks Pro advisor, senior tax advisor, residential real estate investor, residential property manager, financial coach. And as always, before we get started with what's on the board, please allow me to shout out the name Jesus, my Lord, my God, my Creator. Thank you. All right, America, on the board we have this hypothetical scenario of somebody who filled out one of my Microsoft Excel worksheets, and the person provided me with these figures. For that, this person has a Navy Federal credit card, Lending Club personal loan, okay, credit limit 10,000, APR 18%, balance owed $9,851, monthly payments charged $246.28. Availability, America, remember from prior lessons that the availability is the relationship between the credit limit and the balance owed. That relationship calls for a subtraction operation. 10,000 minus $9,851. That's how we arrive at 149 bucks. Okay. Credit utilization. Credit utilization is the relationship between the balance owed and the credit limit. That relationship calls for a division operation. $9,851 divided by $10,000. That's how we arrive at 98.51%. Okay. Payment rate charge. Payment rate charge is the relationship between the monthly payments charged and the balance owed. That relationship calls for a division operation. $246.28 divided by $9,851. That's how we arrive at 2.50%. Okay? Now, on the Navy Federal credit card, the statement date on the Navy Federal credit card is on the 3rd of this month. Okay? Now, for Lending Club personal loan, it is a 5-year personal loan, 5-year term. Right now we're in year 2 of 5. And the statement date for Lending Club personal loan is on the 1st of the month. Okay? Now we're doing scenario for a single dad. His income, he's on a bi-weekly pay period, so he get paid on the 6th, and the next paycheck will come 14 days later on the 20th. The total for the 2 paychecks after tax is $3,263.24. His debt, $21,011.56. The debt, that's when you add all these balances, $9,851 plus $11,160.56. That's how we arrive at $21,011.56. His expenses, $2,869.24. The expense, that's when we add all these items that we have on the board, every single one of them. Okay. Now, out of these expenses, America, $1,626 could go on a credit card. Okay, these are the expenses that could go on a credit card. Electricity could go on a credit card. Water could go on a credit card. YouTube TV could go on a credit card. Netflix could go on a credit card. T-Mobile cell phone could go on a credit card. Insurance could go on a credit card. Groceries could go on a credit card. Fuel for his vehicle could go on a credit card. Dining in our restaurant could go on a credit card. And when you add them up, the total $1,626. Okay. Now his cash flow, America, remember from prior lesson that cash flow is the relationship between the income and the expense. That relationship calls for a subtraction operation, $3,263.24 minus $2,869.24. That's how we arrive at $394 in cash flow. Okay? All right, America. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to start with the exercise. All right, America. Remember that Ambroise Method calls for a series of steps, and those steps have to be taken at least once a month. And the steps, for those of you who missed that lesson: segregate, compare, transfer, repeat, cash flow, large payment, and then we have to insert the what. WHT. W, which account or accounts to use. H, how much of a payment to send to this account. And T, to pay down or off which debt. Okay? These are the steps for Ambroise Method, and those steps have to be taken at least once a month. Okay? All right. Now let's segregate. The way we segregate America, we segregate by account types. Okay? So when we take a look at the list, we have Navy Federal credit card. That's a revolving credit account. And we have Lending Club personal loan. That's an installment credit account. Okay? So we only have one revolving and one installment. Okay? And I like my revolving on top and my installment at the bottom. Okay, the credit card is revolving, it's on top. Lending Club personal loan, it's an installment credit account, it's at the bottom. Okay, so as far as segregation, the list is perfect. Okay, then we compare. And the way we compare by APR between account types. Okay, well, we only have one of each, one revolving and one installment. Okay, so we don't have more than one to compare. Okay, so one of each. Okay. And when we compare in America, I prefer the higher APR on top and the lower APR at the bottom. Okay, so when we compare between the revolving, well, there's really nothing to compare. There's only one revolving. When we compare the installment, again, we don't have multiple installment to compare against each other. Okay, so we only have one installment. Okay, so as far as comparing, the list is perfect. And when we compare in America, we try to identify the enemy. We try to identify the troublemaker. The account that has the higher APR is generally the enemy. The account that has the higher APR is generally the troublemaker. So in this example, Lending Club personal loan is the troublemaker. Okay. Next, America, we transfer. Okay. And the way we transfer America, we always try to relocate balances from a debt that has the higher APR. Well, the debt with the higher APR, that's Lending Club. There goes the balance. We always try to relocate these balances from higher APR. Then we're going to try to dump it onto a lower APR account. Okay? But when we take a look at the credit utilization, Navy Federal is already at 98.51%. Okay? When we take a look at the availability column for Navy Federal only have $149 available. Okay? So we are too close to what I call saturation point. Okay? We are too close to the limit. Okay? The limit is 10,000. We already owe 9,851, which gives us availability of just $149. Okay? Too close to saturation point, so we cannot do any transfer. Okay? Because we're too close. Okay? So next, America, we repeat the transfer. Okay? Well, in this particular example, we did not do any transfer to begin with, so we're not going to repeat any transfer. Okay? And again, we are too close. 98.51%, we're close to 100%. 149, okay? The balance is too close to the credit limit because we do not want to go above the, well, we cannot go above the credit limit to begin with, okay? All right. So then we have condition, adjustment, restriction, exception. From past lesson, I keep mentioning to you guys about condition, adjustment, restriction, exceptions, but today we're gonna put these things into practice, okay? And again, the C.A.R.E, C for condition, A for adjustment, R for restriction, and E for exceptions. Okay. Okay. Sometimes when we do an Ambroise method, we might come across some condition to the strategy, some adjustment that we have to make to the strategy, some restrictions, some exceptions, okay? That's our C.A.R.E, all right? So, we're not able to do any transfer, okay? And all these items, America, were above the line. So, when we're done with whatever's above the line, then we have to go downstairs, we have to go below the line. Well, you know, we didn't do any transfer, okay? So now we're gonna try to figure out, can we use cash flow or can we use a large payment? Okay. Single dad during this period did not have any income tax refund. Single dad during this period did not have any bonus check. Single dad during this period did not receive any additional funds or money that would constitute or represent a large payment. So in that case, we're going to be dealing with cash flow. Okay. So now let's figure out how much our cash flow is. Okay. Well, our original cash flow was $394, okay? So our new cash flow is still gonna stay $394. Why? Because we did not do any activity at all so far. We did not do any transfer, okay? So the cash flow will stay the same, okay? All right, so old cash flow, original cash flow $394. Our new cash flow still $394, okay? And again, we did not do anything. We did not do any transfer. We did not repeat any transfer. We did not do anything at all in this particular example, okay? So now we've determined what our cash flow is, $394. So now, America, let's insert the rest of the question. WHT, W, which account or accounts to use, okay? Remember, America, on our method, Ambroise method, we have two different type of users. We have what we call a normal user put that a little lower. So normal user, and we have what we call an advanced user. And remember, America, when you're paying off debt, you're going to come across three main elements, three main assignments, three main jobs. And these elements, these assignments, these jobs are transfer, alternative account, and cash flow. Okay? That's our TAC. Okay? So T for transfer, A for alternative account, and C for cash flow. Okay? All right? And for a normal user usually takes advantage of transfer, takes advantage of cash flow. Okay? A normal user for our method does not take advantage of the alternative account. Why? Because they don't quite understand the alternative account yet. Okay? Meanwhile, an advanced user takes advantage of every item that we have on the board. An advanced user takes advantage of transfer, takes advantage of the alternative account, takes advantage of cash flow. Okay? And again, for our method, on our method, we have these two different types of users: a normal user or an advanced user. Okay? Now, if you fall under a normal user category, okay, obviously you're going to take advantage of transfer. In this particular example, we could not do any transfer because we were too close to the credit limit. And again, our credit utilization was 98.51%, close to 100%. Our availability was only $149. Okay. We could not dump any of that balance from the higher APR to the lower APR because we were too close to saturation point. Okay. So now we're going to trying to take advantage of cash flow. Okay. So for a normal user, okay, once the income start coming in, $3,263.24. As the paychecks start coming in, half of it on the 6th, half of it on the 20th, okay? You're gonna deposit all that paycheck in your checking account for for a normal user, okay? So deposit the paycheck to the checking account, and you're going to use that checking account to pay off debt, okay? And the way it's gonna work, every bill's gonna receive just minimum payment, so you could satisfy these bills, and whatever is left over, in this case we've already determined that the cash flow is $394, so that excess payment will go to the higher APR account. In this case, the excess payment $394 will go to Lending Club Personal Loan. And again, folks, for a normal user, okay, as the income start coming in, you're going to deposit the income to your checking account. Then you're going to use your checking account to pay off these bills, these expenses. Okay. Every item going to receive the minimum payment or whatever regular payment. Okay. Any excess payment, in this case we've determined that the excess payment was $394. That excess payment will go to the account with a higher APR, which is Lending Club Personal Loan. Okay, for a normal user. Okay? Alright. But now, we're doing a scenario for an advanced user. Okay? For an advanced user, we always try to identify three main accounts. Okay? The first account will be first in line, or the account for greater result. Okay. In terms of reducing interest cost. The next account we're trying to identify is the next in line account, or the account for greater liquidity. And the third and final account we're trying to identify for an advanced user is the alternative account for movements of income and movements of expenses. Okay? And again, these are all three accounts for an advanced user. The first in line account, or the account for greater results, the next in line account, or the account for greater liquidity, and finally the alternative account for movements of income and movement of expenses. Okay? So let's figure out our account. And again, the first in line account, or the account for greater results, in terms of reducing interest cost, is generally the account with a higher APR. Okay, well, on the board, we have 18% and 27%. 27% is the higher APR, and that account that is the higher APR is Lending Club. Okay, so for greater results, in terms of reducing interest costs, it's going to be lending club. Personal loan. Okay. All right. So the next account, next in line account, or the account for greater liquidity. Okay, well, let's take a look. We have Navy Federal and Lending Club personal loan. Well, Lending Club is a personal loan, so that one's not going to offer us greater liquidity. Navy Federal is a credit card. We said the bills that could go on a credit card were limited. Only $1,626 could go on a credit card. Meanwhile, our expenses is a lot higher. Expenses is $2,869. So the Navy Federal credit card was limited. So these two accounts cannot offer us greater liquidity. So in this case, America, our regular checking account will offer us greater liquidity. Okay? So it'll be a regular checking account. Okay? All right. So the third and final account we need to identify for an advanced user is the alternative account for movements of income and movement of expenses. Okay, well, let's take a look. Lending Club personal loan, it's a personal loan, so Lending Club is not an alternative account. It's a personal loan. Okay? Remember, for our purpose, an alternative account is an account where income could come in and expenses could go out, or deposit could come in and withdrawal could go out. Okay, just like what my competitor like to say, it's a two-way account. Okay, so Lending Club is not a two-way account. Navy Federal, okay, money could come in and expenses could go out. Okay, so the alternative account for movement of income and movement of expenses in this case will be Navy Federal. So now we've identified our three accounts for an advanced user. Okay? So now let's figure out our numbers. We have the regular payment. Okay. Then we have bills that could go on a credit card. Okay. Then we have remainder bills, or the bills that could not go on a credit card, or the remainder bills in general. Okay. And we have cash flow. Okay. And we might have absorption or absorption opportunity. Okay. And our total. All right. So for Lending Club, the regular payment for Lending Club is $396.96. Okay. Okay. Put that a little lower. Regular check-in account. And we have Navy. Okay. So $396.96 for Lending Club. Navy Federal credit card, the regular payment is $246.28. Okay. Bills that could go on a credit card. Well, Lending Club is not a credit card. The regular checking account is not a credit card. Navy Federal is a credit card. So bills that could go on a credit card, $1,626. Okay? Other remainder bills, let's skip that one let's leave that alone for now. Cash flow 394. Remember, America, when you're paying off debt, cash flow is better served in the account that has the higher APR. Well, we've identified earlier that Lending Club has the higher APR. So cash flow will go to Lending Club, 394. Alright, absorption, let's leave absorption alone for now. Let's go back to other bills, other remainder bills. Okay. Remember, America, that single dad, his total income would be $3,263.24. So that would be $3,263.24 minus all these amounts. So minus $396.96 minus $394 minus $246.28 minus $1,626. Other remainder bills that could not go on a credit card, okay? The account that offer greater liquidity, okay? That's the next in line account. That was a regular checking account. We'll take care of those, okay? So for other bills, the regular checking account will take care of it. And the remainder bills are $600. Okay? All right, which represents the prepaid college tuition, $600. Okay? Because remember, a single dad could not pay the prepaid with a credit card. Okay? Because that particular servicer wants cash or check for the prepaid college. So cash or check. Okay? All right? Credit card couldn't take care of that because you need cash or check. Could not go on a credit card to prepaid college. All right? So, and again, the account that offer greater liquidity, in our example, that's the regular checking account, will take care of the bills that could not go on a credit card, which is the prepaid college. Okay? All right. Now, America, when we take a look at Navy Federal credit card, we see two different payments going to the Navy Federal credit card. And the Navy Federal credit card is at 18%, which is lower than 27%. Remember, America, we do not want to send too much payment to an account that is at 18% when we have a 27% account on the board. Okay? So for that reason, the account that offers greater results, in this case, that is Lending Club, that account will absorb one of these two amounts. Okay? But now, earlier, I mentioned to you guys that we have the C.A.R.E condition, A for adjustment, C for condition, A for adjustment, R for restrictions, and E for exceptions to the strategy. Why I'm bringing that up? Because remember, America, when we take a look at the Navy Federal itself, the Navy Federal is close to 100%. And the amount that we have available is only $149. Okay? And again, we're too close to the credit limit. All right? So for that reason, we have to make some adjustments because we don't want to go above the credit limit. Okay? And again, credit limit $10,000. We owe $9,851 on the Navy Federal. Okay? So, when it comes to absorptions, America, for lack of better terms, we have three different types of absorptions. Okay? We have what we call no absorption. No absorptions, that's when the absorption is $0. We did not absorb anything. Okay? We have what we call a full absorption. A full absorption, that's when you absorb a full amount. Okay? Whether it's the smaller amount or the larger amount, once you absorb a full amount, that's a full absorption. Okay? So in this case, 1626 has to take care of bills that could go on a credit card. So we know we're going to try to absorb the smaller amount to 4628, which represents the minimum payment on the Navy Federal credit card. Okay? So that would have been a full absorption, 246.28. We have another kind of absorption that I call a partial absorption. A partial absorption, obviously, is an absorption that is between a no absorption and a full absorption. So it's going to be a figure, a number, an amount that is between 0 and 246.28. So it will be an amount that is greater than 0, so greater than the no absorption, but less than the full absorption. Okay? That's a partial absorption. So it's going to be greater than 0, which is a no absorption, but less than a full absorption. So any number that is between the no absorption and the full absorption, we refer to it as a partial absorption. Okay? Why? Again, the account that we're trying to absorb from, that account is very close to saturation point. Look at the credit utilization, 98.51, close to 100%. Look at the availability, 149. The balance owed, 9,851, too close to that 10,000, okay? So for a situation like that, we're gonna go with either a no absorption or a partial absorption, okay? That way we create a little bit of cushion, okay, between the balance owed and the credit limit, because we do not want to go above the credit limit. Okay? Well, that would not be the end of the world if you go above the credit limit, but it's not a good thing to go above the credit limit. So we're going to try our best not to go above the credit limit. All right? Okay. Now, James, how much then would the partial absorption be? Since we do not want to do a full absorption, okay? You know, we have to make an adjustment. Okay, so the 246.28, we cannot absorb the entire 246.28. We have to absorb part of it. Okay? Well, how much that partial absorption is going to be? America, let's see which account that we are dealing with. We are dealing with a Navy Federal credit card. So Navy Federal is a credit card. How do most of these lenders, most of those creditors arrive at that 246.28, 246.28 for monthly payments charged? Okay. The way, America, these companies arrive, these creditors, these lenders, this credit card company arrive at the 246.28, most of them, they use the interest charge. So the regular monthly payment, they use the interest charge for the cycle plus 1% of the statement date, of the statement balance. Okay? That's how they arrive at that 246.28. So let's assume the statement balance is 98, well, it is 9851. So 9851, so $9,851, okay, times 1%, okay, obviously to 0.90, this one's going to be $98.51. That's that 1% portion. And the interest charge, obviously if it's 246.28, that'll be the remainder. So 246.28 minus 9851. Okay. 246.28 minus 9851. So 147.77 would have been the interest charge for the month. For the cycle, okay? So that's how they arrive at the monthly payment charge. Most of those lenders, okay? They use whatever the interest charge for the month plus 1% of the statement balance, okay? We assume the statement balance 9851, and again, the statement date was on the 3rd of this month, so on the 3rd of this month, it was 9851. Okay, let's say we're doing this transaction one day later on the 4th, so the statement balance will still be 9851. 1% of 9851 is $98.51, so the remainder would represent the interest charge. Okay, so if we're trying to break it down, I'm using simple numbers to keep my math simple. 18% divided by 12 would have been 1.5%. 1.5% times 9851. Sure enough, 147.77. Okay? And again, remember Navy Fed was charging 18%. To keep our math simple, we're doing 18% divided by 12. That would have been 1.5% in interest. 1.5 in interest times 9,851. So that would have been 147.77 in interest. Okay? So, having that knowledge, America, knowing how the bank arrived at the monthly payments charge, we know it's comprised of two separate figures, at least two separate figures, because sometimes you have some fees for being late and things like that, but generally it comprises of two separate figures, okay? And some other penalty. So generally the interest charge for the month plus 1% of the statement balance. Okay, we're assuming the statement balance was 9,851. Okay, we're assuming we're doing all these transactions after the statement date. So after the 1st, after the 3rd. Okay, so 1% of $9,851 is $9,851. Okay, that's that 1% portion Because remember, that monthly payment charge, again, is made up of two separate numbers, okay? Generally, the interest charge and 1% of the statement balance. So if we kind of break them down, okay? So 1% of the statement balance, 1% 98.51 would have been $98.51. So whatever remainder would be towards interest charge, okay? Barring any fees or other late fees and some other stuff, okay? All right? So, and again, going back to our no absorption, which is 0, full absorption, that is the 246.28, but we cannot do full absorptions because we're too close to saturation point. 98.51, only 149 remaining. So in this case, we're going to do a partial absorption. Okay? So how much of that partial absorption can we do? Okay? We know at a minimum, we have to pay the interest that's going to be charged on the account. Okay? So if we pay the interest, okay, the figure that remains is the 1% of the statement balance. Okay? So we could at least absorb that 1%. So in this case, we're going to observe the 98.51 because we do not want to observe too much since we are too close to saturation point. But at the same time, we don't want to leave too much payment in the account that is at a lower APR, so we're going to observe some of it. Okay? We're going to make sure at least we pay our interest, whatever that is above the interest. 98.51, that's the amount we're going to observe. Okay? So if we observe 98.51 out of the 246.28, okay? So now our new number now going to be remaining going to be 147.77. Okay. All right. So this is a process, America, that I call safe harbor rule or safe harbor rate. Put that on the board. Safe harbor rule or safe harbor rate, okay, which is 1% of the statement balance. Okay, or the average daily balance, whichever is smaller. Okay? This is just a safe number to observe on the partial absorption. Okay? With regards to credit card. Alright? So we know, since again the credit card company as of today, and today is August 11th, okay, 2024. So as of today, this is how they arrive with the monthly payments charge. Most of those credit cards, not all, most of those credit cards. Okay? The monthly payment charge is comprised of interest charge plus 1% of the statement balance. Okay? So we want to at least pay our interest. So whatever that would go, that 1%, that would be earmarked sort of towards the principal for that account. Okay? That's the account, that's the amount we're going to absorb. Okay? We're going to remove, we're going to steal from the lower APR account. Okay? 98.50 on the 1%. Okay? Because why? That's the rule. 1% of the statement balance plus interest. That's what most credit card companies are using. Okay. Now, if he was, say for example, if he was a personal line of credit, we know some personal line of credit company, some company that offer personal lines, they charges interest only, and you have others that charges a flat fee. You know, I come across one like I believe it was Regions, where Regions charges 3%. Okay, so 3% on a personal line. Okay, and let's assume if it was a personal line, let's assume the interest was 18%. Okay, same thing. We know 18%. 18 divided by 12 is 1.5. Okay, so since they're charging 3% total to arrive at the monthly payments charge with regards if it was the personal line of credit, so it will be 3% minus 1.5. So we'll still be left with 1.5. Okay. So in a situation like that, if it was a personal line of credit that charges a flat fee of 3%, our safe harbor rule would have been whatever that is above the minimum. Well, above the minimum is 1.5. Okay, so it would have been 1.5 times, let's assume the numbers were the same, 1.5 times 98.51%. Okay, that will be only the portion we'll absorb, just that portion. 98.51 times 1.5. Okay, it would have been 147.77. Okay. Now, how would the safe harbor then work if it was a personal line that only charges interest only? Or if it was a home equity line of credit that only charges interest only? Okay. And again, let's assume it was 18%, which is quite high for a personal line, but you know, some of them do charge 18%. So if it was a personal line of credit, or if it was even an ELOC that charges 18%, okay, and that personal line or ELOC would be at a lower APR than say the lending club personal loan. Okay, so how much then we will absorb? So let's assume the number, well, in this case, personal just interest only. So let's assume it was 18%. So if we break it down per month, 18% divided by 12, that is 1.5. Okay. So the personal line or the ELOC will be charging interest only, 1.5. Okay. So remember, for our safe harbor, we want any number or any amount that is above the interest only. Well, they're only charging interest only in this particular example. There's no amount that is above the interest only. So in this case, we would have a no absorption because we do not have any amount that is above, okay, the interest charge for the cycle. All right? So our safe harbor rule or safe harbor rate is 1% of the credit card if the credit card charges 1% of the statement date. If later on they change the rule, because you know with those credit card companies, again, our government allow them to do whatever they want. Okay, whatever the new rate is, that'll be our safe harbor rule. Okay, for a company that charges a flat fee, like a Regions personal line of credit as an example. Okay, and again, our safe harbor will be, our safe harbor rate will be whatever rate that is above, okay, the monthly interest charge. Okay, that's the amount we'll absorb. Okay, if it's an ELOC or personal line that does not charge a flat fee, that charges only interest only, well, our safe harbor will be 0, so no absorption. Because again, we want to be above the monthly interest charge. In this case, there's no amount above the monthly interest charge for the cycle if it was an interest only. Okay, you know, I'm sounding kind of redundant. I just want to make sure though that you guys fully grasp the concept, okay? When I talk about the safe harbor rule or the safe harbor rate with regards to how much needs to be absorbed, okay, from a lower APR account. Okay, so out of the 246.28, we're gonna absorb 98.51 out of it, so the remainder only gonna be 147.77. All right, America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right. So, why the safe harbor rule? And again, that is for some of you guys who are having a hard time figuring out how much the absorptions needs to be. So with regards to credit card, just grab 1% of it. But it has to be 1% of the statement balance or 1% of the average daily balance, whichever is smaller. Okay? Not the greater amount, the smaller out of the two. Say the statement balance, for example, is 10,000. But the average daily balance, because remember, some company, they use a average daily balance with compounding. So the average daily balance, let's say it's 10,008, okay? As an example, okay? So a number, the average daily was greater than the statement balance. In this case, we're gonna use 1% of whichever is smaller. So 1% of 10,000, not 1% of 10,008, okay? Because we wanna absorb the smaller amount. 1% of the smaller amount, not the larger amount, okay? All right, so, and again, safe harbor rate, 1% of the statement balance, or 1% of the average daily balance, whichever is smaller, okay? That's our safe harbor rule, okay? So, you guys don't know how much to absorb, just grab the safe harbor rule, you're done, okay? But for us, we are more aggressive, we're not going to use the safe harbor rule, okay? But for you guys who don't quite know what you're doing as of yet, just absorb 1% if it's a credit card. And again, 1.5 in this example if it was a personal line of credit that charges a flat fee, or no absorption if it was a PLOC or ELOC that charges only interest only. So we use 3 examples here. One with no absorption. This one would be no absorption. Here will be a partial absorption. And the credit card here was a partial absorption. Okay. Cannot do a full absorption again, America. We are too close to saturation point. Okay. Okay. This is why we refer to sometimes as situational awareness. I don't know where you are with these accounts. Man, I'm close to 10,000, the 10,000 credit limit, you know. In a scenario like this, I cannot have a full absorption. Okay, in a scenario like this, it has to be a partial absorption. Okay? So safe harbor 98.51. Okay? But for us, we are more aggressive than that. We don't do safe harbor. Okay? 98.51. We'll go a little higher. Why? Because we know when we have movement of income, that's 1626, and movement of expense, okay, because 1626 is going to touch down the account, and 1626 going to leave that account to pay off these bills, because these bills could go on a credit card. We know just having that movement, our interest charge is going to get reduced. So our interest charge is not going to be 147.77. It's going to be a lot smaller, okay? So in our case, we'll be able to absorb more than 98.51, okay? If our interest is smaller. Okay. And again, it would have been 246.28 minus the smaller interest. Okay. So now we have a bigger amount to absorb if we stay away from the safe harbor rule or the safe harbor rate. Okay. Since we want to be more aggressive. Okay. But for now, let's leave it at safe harbor. Let's try to figure out our numbers. Okay. So, lending club now is $396.96 plus $394 plus $98.51. So lending club now will have a total of 89.47. Okay. That's how much needs to go to the lending club account. The regular checking account, $600. So the total for the regular checking account will keep $600. And the Navy Federal credit card, we only keep $147.77 plus $16.26. So $147.77 plus $16.26. So Navy Federal will keep $1,773.77. Okay. All right. So going back to our step, which account? We know lending club for first in line, or the account for greater results. So we have lending club and regular checking account. And Navy Federal. That's our three accounts for an advanced user. Okay. How much to send to this account? Lending club, $889.47. Regular checking account, $600. And Navy Federal, $1,773.77. Okay. Now the last and final question that we have to answer: to pay down or off which debt? Okay. That'll be the workflow. Alright. So that's our workflow. Again, single dad get paid on the 6th, so, and on the 20th. Okay. So the paycheck on the 6th, paycheck on the 20th. Okay. So the paycheck on the 6th starts down the checking account. So where does the money go? And again, we're assuming that these two paychecks are equal. So $3,263.24 divided by 2, 3263.24 divided by 2. So that is 1,631.62. Gonna touch down the first paycheck, and 1,631.62. Gonna touch down the second paycheck. Okay. Again, money touch down the checking account. So checking, and we have lending club. And we have Navy Federal. Okay. Again, checking, lending club, Navy Federal. Okay. So $1,631.62 touch down the checking account. Where does the money go? So this is when, America, you have to pay attention to the due dates. Okay. Especially for bills, expenses that you need cash or cash equivalent for. Okay. Electricity do on the 28, 28, 28, 28, 28, 28. That's not going to create any problem for us because all these bills are due towards the end of the month. Groceries doesn't have a due date. I guess single dad could decide to do groceries at the end of the month. Okay. Fuel, $280. I guess single dad could put fuel in a vehicle once a week. So about maybe 4 times per week. Okay. In the vehicle. And that amount will go on a credit card. Okay. So that one might create might create a little problem for us. Dining out, I guess single dad could decide to go to the restaurant towards the end of the month. Okay. So this fuel might create a little problem because we have to apportion it once a week. Okay. The prepaid card is $600. Okay, that one you need cash or cash equivalent for. Okay, so the checking account we know for sure will keep $600. So we know the checking account will keep $600. Okay. Navy Federal is doing the 28th, and again, that's towards the end of the month. Lending Club is doing the 26th, that's the end of the month. Okay, let's take care of the first paycheck. First paycheck touches on the account on the 6th. The next paycheck is on the 20th. So for first paycheck, that first paycheck will cover anything between the 6th all the way through the 19th. Okay. And the paycheck on the 20th will cover anything between the 20th towards the end of the month. Okay? So let's take out the first paycheck first. Okay? We have nothing coming due between 6 and 19. We have nothing coming due. Everything's on the 28, 28, 26, 26, 26. Except for the fuel, since we're doing it once a week, looks like this is gonna go, so maybe, I don't know, 7, 14, 21, 28, maybe on the few. Okay? Maybe. So, for every other account, we have no issue with the due date. Okay? Everything is after the 19th on the first paycheck. After the 19th, everything is on the 28, 28, 26, 28, 26. Okay? So in this case, the account that offers greater liquidity will take care of those. So Lending Club has the higher APR, that's the account with greater liquidity. Lending Club will get the entire amount, I'm sorry, $889.47. And again, we have no issue with due date, so the account that offers greater liquidity will get its entire amount at $89.47. Okay? And between the Navy Federal and regular checking account, Navy Federal, they're charging us interest on the Navy Federal. Regular checking account, they're not charging us anything. Okay? So the next account that takes precedence is the Navy Federal credit card. So whatever remainder will go to the Navy Federal credit card. Okay? And again, they're charging us interest on the Navy. They're not charging us anything on the regular checking account. Okay? So remember, our goal is to reduce our interest cost. So we have to send payment to where they're charging us interest. Okay? And Navy Federal, the regular checking account, they're not charging us anything. So total income, $1,631.62 minus $889.47. Okay? So the remainder will go to Navy Federal, $742.15 on the first paycheck. Okay? All right, America, you guys got to know how to allocate these paychecks, okay? Now, on the next paycheck, regular checking account needs to have $600. Regular checking account did not receive anything on the first paycheck. So now we know the regular checking account will get the entire thing, so $600, okay? Lending Club needs to have total $889.47. Lending Club personal loan already received everything on the first paycheck, so now Lending Club not gonna receive anything on the second paycheck. Okay, so now the remainder will go to the Navy Federal. So it's 1631.62 minus 600 bucks. So that remainder 1,031.62 will go to Navy Federal. And when you add them up, 1,031.62 plus 742.15, and the total, sure enough, is $1,773.77. Okay? And again, America, gotta know how to allocate these paychecks. Gotta know which account takes precedence over other accounts. Okay? Once you have this basic understanding, everything should be much easier for you to do. Okay? All right, America. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, so now go back to our bills: electricity, water, YouTube, TV, Netflix, T-Mobile, insurance, grocery, fuel, dining out. All these gonna go on a credit card. Okay, on the 28th. The fuel on the credit card, we have enough on the first paycheck to cover this fuel. 280 on the first paycheck, we have 742.15. So more than enough to cover whatever needs to be allocated towards fuel or gas for his vehicle. Okay. All right. So all those, the total 1,626, 1,626. And then a partial payment, 147.77. Okay. So Navy Federal will take care of all of these. Navy, 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 Navy. Navy Federal will accept its own minimum payment, 246. So Navy. Lending Club will accept its own payment, $396.96, $396.96. Navy Federal will accept the cash flow, $394.94. And Lending Club, and Lending Club will absorb part of the Navy Federal, or part of that 246, which is 98.51, which was the safe harbor rule, 1% of the statement balance. Okay. All right. So this one is landed. So all our bills are accounted for. Navy Federal will take care of these. The prepaid college, the checking account will take care of that on the 26th. So on the 26th, the money is already on the checking account. So 6 days later, because the paycheck comes on the 20th, 6 days later, which is the 26th, you just use whatever the 600 bucks that's inside the checking account and send it to the servicer for the prepaid college tuition. Okay? For the benefit of his child. Okay? Navy Federal, again, Navy Federal gonna take care of that, but only part of it. Okay? Remember, 1626 will go to the Navy Federal. 1626 is big enough or large enough to cover 246. So when you send 1626, okay, that will satisfy the 246.28. And the last bill that we have on the board, Lending Club 396.96, 396.96. Lending Club will take care of its own, okay, regular payment. All right. So now everything is accounted for. All our bills, we know which account will pay which bill. Okay. So now we are done. All right, America, I give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. Again, America, to recap, when we are too close to the credit limit on those accounts, okay, we're going to be a little bit less aggressive, okay? We cannot absorb the entire amount from a lower APR account. We have to absorb, we either have to have a no absorption or a partial absorption. Okay? And again, situational awareness. We are too close to the credit limit. We do not want to go above the credit limit. Okay? So in situation like that, either no absorption or a partial absorption. Okay? Or if we're going to use a partial absorption, you gotta know how they arrive with the monthly payments charged. Okay? Most credit card company, they uses the monthly interest charge for the month plus 1% of the statement balance. Okay? So if you're trying to extrapolate, trying to separate them, okay, we want to at least pay our interest. So we're going to pay the interest, and whatever that would normally be earmarked to go to principal for the lower APR account, that's the amount we're going to absorb. So since it is interest plus 1%, okay, we're going to at least take care of the interest on that lower APR account. So the amount we're going to absorb going to be the excess, which is that 1% that they charge in order to arrive at the monthly payments charge. Okay? This so-called 1%, we refer to it in America as the safe harbor rule or safe harbor rate. Okay? And it doesn't have to be 1%. It's whatever amount that is above the interest. That's the amount that's the figure we're going to absorb. Okay? If it's 2% above the interest, we're absorbing 2%. If it's 3% above the interest, we're absorbing 3%. If it's 1.5% above the interest, we'll absorb that 1.5%. Okay? That is the safe harbor rule or the safe harbor rate with regards to the absorption. Okay? Whatever that's above the interest, that's the amount we're going to absorb. Why? Again, we do not want to send too much payment to a lower APR account when we have a higher APR account on the board. So we're going to absorb something. And for those of you who do not know what you're doing, use the safe harbor rule or the safe harbor rate. Okay? But if you know what you're doing, do not use the safe harbor rule, do not use the safe harbor rate. Okay? Because remember, when you have a movement of income and movement of expenses in this account, the interest charge gonna be a lot lower, which means there's gonna be a little room for you to steal from that interest charge. Okay? All right. But if you do not know what you're doing, just use whatever safe harbor rate. All right. Which is 1% of the statement balance, or 1% of the average daily balance, whichever is smaller. Okay? All right, America, I think that's it for me today. Again, America, my name is James Ambroise. I am the author, creator of Ambroise Method 1.0 and Ambroise Method 2.0. Ambroise Method, America, is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to debt snowball, debt avalanche, velocity vacuum. Okay? Thank you, Jesus. Until next time, America. Good morning.